Welcome to this session on measuring and monitoring interest rate risk. Over the course of this video, you will gain a good understanding of how to determine the level of risk in your balance sheet and how to evaluate an interest rate risk report. Let's start with the basics. What is interest rate risk? It's the risk of potential loss from unexpected changes in interest rates, which can result in a significant impact to a credit union's income and liquidity. Our economy goes through interest rate cycles. When the economy is growing and there are inflationary pressures, the Federal Reserve will increase interest rates to slow the economy. When the economy enters into a recession with falling inflation and rising unemployment, the Federal Reserve will lower the Fed funds rate to stimulate the economy. Changes in the federal funds rate directly or indirectly impact the credit union's assets and liabilities, and ultimately your bottom line. As a result, credit unions have an ever-present need for measuring and monitoring interest rate risk. Here's why it's so important to keep an eye on risk. When it comes to asset liability management, or ALM, your credit union needs to have policies and limits in place to safeguard your balance sheet. You don't just hand out loans for any amount or purchase an investment without looking at specifics, right? The same protections are necessary for interest rate risk. By implementing measurement systems to track interest rate risk, you can monitor those risks and adjust your business decisions as needed. That way, your credit union is well positioned to meet strategic goals and achieve financial success, while also maintaining liquidity levels needed to provide services to members. So let's get to the different methods of risk measurement. There are two ways to measure risk: income simulation modeling, which is a measurement of short-term risk, and net economic value, which is a measurement of long-term risk. When used together, they become a powerful tool for decision-making. We'll discuss income simulation modeling first. This method is focused more on determining risk from an earnings perspective. It is easiest to think of the income simulation modeling as a projected income statement. This report projects future net interest income and how it will change as interest rates move over a short-term horizon, generally over just a few years. What this does is take a look at current data, meaning all of your shares, all of your loans, any borrowing that you're holding, and your investments. The information is then fed into the model to see how your income, based on current interest rates, would change if rates were to go higher or lower. It's basically a stress test for your projected earnings to see how it will hold up under a range of future interest rate changes. And while this can be an effective tool to gauge interest rate risk, it does depend heavily on assumptions. For example, if you had a loan with the credit union and paid $400 per month, the model replicates this payment. It will reinvest the cash flows, in our example $400 each month, at the current rate and term to project the future earnings of the credit union. Other assumptions are layered in as well, such as prepayments and non-maturity share sensitivity. So let's look at how an income simulation model is laid out. The base case, or flat rate environment, assumes that there is no change in interest rates. In this example, you have $3 million in interest income and you're paying out $1.3 million in interest expense. Your annual projected net interest income is $1.7 million. Now we're going to take the exact same balance sheet, but just run it under a different market scenario. In most cases, ALM models assume a 300 basis point increase and decrease in interest rates. These parameters are implemented as they demonstrate circumstances that are extreme enough, but still within the realm of possibility, to give you a reliable simulation. These models shock the current yield curve, resulting in an instantaneous and parallel rate shift. In the scenario that rates go up by 300 basis points, interest income would increase to $3.1 million. However, interest expense would also increase, and even more than the interest income. So instead of interest expense of $1.3 million, you're now looking at $1.62 million. That means your net interest income would decrease to $1.48 million, a 12.9% decline. Using the same example, if rates go down by 100 basis points, the projected interest income decreases to $2.9 million, and you have an even greater decrease in interest expense to $940,000. Your annual projected net interest income would actually increase by 15.3% to $1.96 million. Now that we know the potential impact to net interest income given various rate environments, what do you do with it? The first place to look is your policy limit, because you want to make sure that you're within the stated parameter. In this example, your policy says as long as your net interest income doesn't decline more than 20%, then you're okay. It would be beneficial to take this a step farther and look at past trends. Let's just say 2 periods ago, you saw a decline of 8% in your net interest income, and in the last period, it was 10%. While you're still well within policy limit, the trend is moving up. So the next step is to find out what's causing the credit union to take on more interest rate risk. When reviewing model results, it is important to pay attention to the more likely scenarios given the current rate environment, while also keeping an eye on the opposite rate path. The purpose of modeling is to be prepared and understand the inherent interest rate risk in all environments to ensure we are prepared for unexpected events. The other method we use when evaluating interest rate risk is net economic value. Net economic value, or NEV for short, differs from income simulation modeling because it has a longer-term view of interest rate risk. It's the measurement of the future earnings potential for your current balance sheet. Here, risk is measured by the change in the value of the credit union's assets and liabilities due to interest rate movements and the impact these changes have on the institution's capital position. Before we get into the specifics of NEV, it's important to note that this method is really useful as an early warning indicator. Think of it like going to the doctor for your annual physical. He performs an exam, checking for any signs of potential future problems. If he finds that your blood pressure is elevated or your cholesterol is a little high, he will let you know of these early warning indicators and tell you that you might want to change something you're doing so you don't have bigger health problems down the road. That's what NEV provides for your finances. It gives you an early warning indicator of risk within your balance sheet. These risks might not cause problems over the next few years, but it could have an impact on the longer-term health of the credit union, say maybe 5 or 10 years down the road, which could potentially impair capital. What is the formula for determining NEV? First, you take the present value of future cash flows that the credit union will receive on the asset side of the balance sheet, such as loan principal and interest payments, as well as investment principal and interest. You then take the asset value and subtract the present value of future cash flows you will pay for funds, such as deposit principal and interest payments. What you get is the difference of present value of assets less the present value of liabilities, and that's the net economic value. Maturities of fixed-rate accounts play a big role in the impact of NEV. Shorter maturities generally have a smaller value change, while longer maturities have a larger value change. It makes sense given the present value calculation. $1 today is worth more than $1 30 years from now. If your credit union offers 30-year fixed-rate mortgages, it's inevitable that rates will fluctuate during that time period. If rates go up after the interest rate on the loan has been fixed, the asset value will decrease because you won't be earning the full potential of the higher rate that is now available. Or to put it another way, the mortgage loans you hold on your books are not as valuable as current loans in the market because they have a lower rate. However, if interest rates go down, the opposite is true. The interest rate on the loan will be higher than the current rate new members get when obtaining a home mortgage. This will provide an increase in value as current loans in the market have a lower rate than those you hold. The valuation would be lessened if the cash flow stream was shorter than the 30-year fixed-rate loan we've been discussing. There would be smaller changes in the value if the loan was a 36-month auto loan because the impact of holding an asset with a rate higher or lower than the current market rate is over a shorter time frame. Mathematically, the calculation is the same for liabilities and values, and will move in the same direction, declining in value as rates rise and increasing as rates fall. However, from the credit union's perspective, the benefit is opposite because it is on the funding side. Think of it as if you are getting a sale on funding when rates rise and overpaying as rates fall. For example, if the current certificate rate is higher than the certificates on the balance sheet, the value declines, just like the assets. However, this is a good thing as we are holding funding at a lower cost when comparing to current market rates, making it a favorable change. Let's look at this in terms of numbers. If a credit union has present value assets of $146.4 million and present value liabilities of $123.4 million, the net economic value, the value of its capital, is $23 million. If market rates go up, the value of the capital will be reduced to $20.4 million, as there is a larger decline in the value of assets than in the value of liabilities. The change between the base case or flat rate NEV of the $23 million and the upward of 300 basis point rate shock of $20.4 million is $2.6 million, which is a decline of 11.3%. Again, these numbers are projections to help you determine what decisions should be made to keep the credit union financially stable despite changes in interest rates to protect capital. They help you find the red flags that could spell trouble for your balance sheet. As the board of directors, your role is to make sure the credit union is not falling into the traps that these red flags present. If you see any non-compliance with risk limits or there are no risk limits at all, those are red flags. In addition, frequent exceptions to interest rate risk policies, significant changes in the level and trends of interest rate risk exposure to the credit union, and lack of reports or reports that do not identify and quantify interest rate risk levels are major warning signs that the credit union is not well prepared to fight interest rate risk, and that could mean bad news for the balance sheet as well as overall financial performance. So let's recap. Today we've learned changes in market interest rates can have a major impact on the credit union's earnings and capital. Policies and risk limits are the framework for managing interest rate risk. Interest rate risk models are used to measure interest rate risk. These include income simulation models and net economic value simulation. The job of the board is to monitor compliance with policy and risk limits through detailed reports so that interest rate risk is minimized. Thank you for joining us for this session on measuring and monitoring interest rate risk. Have a great day.